Welcome to This Explainer. Today, we're diving straight into the surprisingly powerful math and honestly, the fascinating psychology of what actually happens when you invest just $100 every single month for 40 years. We'll look at the raw numbers, for sure, but we're also going to unpack the emotional roller coaster of just letting time do the heavy lifting. We'll see exactly how a totally forgettable amount of cash transforms into a life-changing financial engine, as long as you can conquer the mental hurdles along the way.
Okay, let's just completely shatter the myth right now that you need some massive windfall, a crazy inheritance, or this flawless financial plan to start investing. Because let's be real, $100 is an amount that just evaporates over a weekend, right? It's a spontaneous dinner, or a couple of streaming subscriptions you totally forgot to cancel, or maybe some random late-night impulse buy you can't even name by Monday morning. It feels tiny, way too small to matter. But as you're going to see today, that completely forgettable $100, that is exactly where this massive journey begins.
Section 1. The Myth of the Windfall.
So, entering this first critical phase, you finally stop overthinking. You quiet that inner critic that kept you from starting last year, and you set up that automatic transfer into an index fund. Boom, done. But almost immediately, you face a reality that looks absolutely nothing like those glamorous wealth-building montages you imagined. Actually, scratch that. It's completely unsexy. You click confirm and, well, nothing grand happens. In fact, the market drops 0.3%, your hard-earned $100 shrinks to $99.70, and suddenly you're anxiously checking your app 3 times before bed. Being immediately punished by a red downward arrow makes it feel like you've made a terrible mistake.
6 months in, and your balance sits at a completely unimpressive $578. You're basically feeding this account every month like a houseplant you're not even sure is still alive. It feels stagnant, right? But beneath the surface, something profound is happening. You are quietly building the muscle of consistency. You're putting in the reps in a financial gym where the mirrors just don't show your progress yet. Your muscles are tearing and rebuilding, the foundation is being poured. Even if day to day you look exactly the same. But hey, you're showing up anyway.
Section 2. The Muscle of Consistency.
This brings us to a major checkpoint. See, the gap between knowing what you're supposed to do and actually doing it when there are zero visible rewards, that is exactly where most people quietly exit. They don't quit in some dramatic blaze of glory. They just miss a month, then another, and the habit slowly fades. After 12 solid months of discipline, you've put in $1,200 of your own money. And for all that effort, you've gained a whopping $112 in market returns, literally an amount you could have made picking up a single afternoon shift. You know $112 isn't impressive, and honestly, that's the psychological trap that catches so many beginners.
But here is the absolute crucial takeaway. This first year, it was never actually about the $112. That return is totally irrelevant right now. What this year was really about was forging an unbreakable relationship with delayed gratification. You proved to yourself 12 times over that the $100 was never actually load-bearing in your monthly budget. Your lifestyle didn't collapse. You didn't even miss it. That realization and the unyielding repetition of that habit is your true foundation. You've essentially firewalled a piece of your income for your future self, and that is a genuine superpower.
Section 3. The psychological shift. Right around the 26-month mark, with your balance noticeably sitting at $3,100, something profound clicks. You undergo a massive psychological transition that takes most people way longer to figure out. You stop monitoring your app from a place of fear, bracing for disaster or sweating over losing your initial deposit. Instead, you begin eagerly watching it out of pure curiosity. You stop waking up terrified of the financial news, and you actually start looking at market dips as a discount. This radical shift in mindset changes literally everything about how you experience normal, everyday market volatility.
And man, that resilient mindset is absolutely vital, because the market will inevitably drop. Imagine it dips 14% over 11 weeks, temporarily evaporating $380 from your account. In the past, you probably would have panicked, but your new mindset ensures you don't touch that sell button. You just let the automatic schedule keep running. Why is this so powerful? Because by automatically buying during that 14% drop, you are quietly scooping up cheaper shares. You're buying on sale. So when the market recovers and your balance hits $3,900 8 months later, your account bounces back significantly higher than before. Your discipline just compounded quietly in the background.
Fast forward to year 5. Assuming a historical 10% average return, which is roughly what the S&P 500 averages over the long haul, your 60 months of stubborn discipline have transformed $6,000 of your contributions into an $8,200 balance. To really put that into perspective, a shocking percentage of Americans don't even have $1,000 in liquid savings for an emergency, let alone over $8,000 sitting in an investment account. You have officially crossed a major threshold. You now possess more dedicated financial runway than a huge portion of the population.
Now, sure, financial experts might scoff and say, well, $8,200 is practically nothing in the grand context of a multi-decade retirement plan. But they're completely missing the point. That $8,200 is undeniable proof that the machine actually works. And even more importantly, it's concrete proof that you are the exact kind of person who feeds it. You didn't set out to get rich in 5 years. You set out to change who you are. You've officially transitioned from someone who merely spends to an investor, and that new identity is worth far, far more than the $8,200 itself.
Section 4. The machine takes over.
Okay, this is where we look at the decades where time, the only investor who never misses a contribution, never panics, and never sells, starts acting like a highly lucrative second contributor to your account. By year 10, the gap is rapidly widening in your favor. Check this out. Your portfolio generated roughly $1,700 in returns last year alone, significantly outpacing the $1,200 you deposited out of your own pocket. The money is literally making money without a single extra ounce of effort from you. Your initial capital just hired itself out to work on your behalf.
And by year 20, the exponential nature of compounding becomes absolutely staggering. What started as that tiny, almost insulting $112 return back in year 1 explodes into $7,000 of annual growth. The machine is completely transformed into the primary contributor of your wealth. Honestly, you're almost just a passenger at this point. Your investments are now putting in a 40-hour work week right alongside you, generating thousands of dollars in value while you sleep, while you take vacations, while you just live your life. The heavy lifting has been fully outsourced to the math.
Fast forward again to age 54. 3 solid decades of simply refusing to stop has turned your total $36,000 of out-of-pocket contributions into an astonishing $227,000. It is so crucial to pause here and remember exactly where this came from. This entire mountain of wealth, nearly $250,000, was built using nothing but that highly forgettable weekend disappearing money we talked about at the very beginning. That same $100 you used to lose to random subscriptions and impulsive takeout orders is now a 6-figure financial fortress.
Consider the sheer income potential you've unlocked here. Your account is now generating nearly $1,900 a month in interest. That is a passive income stream approaching what many people earn working a strenuous full-time job, and you still have a full decade left until traditional retirement age. You could literally stop contributing entirely right now, and the snowball would just keep rolling down the hill, gathering mass all on its own. All of this security stems from money that started as a meager $100.
Section 5. Small beats eventual.
We finally arrive at year 40, age 64. This is where the ultimate results of your stubborn consistency are revealed to the world. Out of your monumental $637,000 balance, a massive $589,000 wasn't earned at a job, it wasn't inherited, and no, it certainly wasn't won in a lottery. It was grown purely by the passage of time and your 48,000 small, boring, repetitive decisions to simply not stop. You let the math do its job across 4 decades, and the result is total financial independence. Ultimately, this explainer proves a very specific mathematical reality. Small and consistent completely destroys large and eventual. The investor with 40 years of discipline wins every single time. Think about the other investor, the one who waited 20 years to finally get that promotion just so they could afford to invest a hefty $500 a month. Even contributing way more cash each month, the math still beats them. Their intentions kept getting delayed by waiting for the perfect time or the bigger paycheck. But time is the only irreplaceable asset in investing, and folks, it simply does not wait.
Knowing that time runs purely on whatever you give it and absolutely does not wait for the perfect amount to magically appear in your bank account, the choice is entirely in your hands. You've seen the raw math, you understand the psychology, and you know the undeniable power of simple repetition. So the only question left to ask yourself today is, what will your $100 build?